Welcome back to Bazaar Morning Call. You have so much happening in the market. We are all set to hit all-time highs. We have market expert Ajay Bodke joining us now to talk about how he's placed in the market. Ajay, before I ask you about your sentiment in the market, I wanted to talk about the new listings which have done fabulously well, right? Whether it's Irida, whether it's Tata Technology, Gandhar Oil as well. What would your pick of the pack be where you will buy even now despite the kind of rally that we've seen? Or are you cautious?
Good morning, Sonia. Thanks for having me on the show. I think all the three names that you mentioned have listed, in my opinion, extremely high, I would say even frothy valuations in certain cases. Just to take an example in case of Tata Technologies, although it is, the business model is quite robust with higher standards of corporate governance and transparency from the Tata Group and the first offering from the group in many years, I think it would rank as one of the most expensive pure play ER&D companies, not only in India, but also globally. What market seems to be ignoring in the current exuberance is the high client concentration the company has, with nearly 55% of revenues coming simply from Tata Motors and its subsidiaries, and more than, 70% revenues coming from the top 4 or 5 clients. Also, the concentration in one sector, 70% of revenues come only from automobile sector. No doubt that the reliance on developing products on the EV side bodes very well for the order flow for KPIT as well as Tata Technologies. But the valuation itself is making me a bit worried. At 400 rupees, I think if you look at the valuations, it's trading at roughly 90 times FY23, it's trading earnings, vis-a-vis something like 80 times for KPIT. How long these valuations would sustain is a concern. Also, with the US and European economy clearly slowing down, I think the order flow for the entire ER&D sector, where the orders are more discretionary in nature, also needs to be kept a close watch. On the positive side, the company is diversifying and trying to broaden its revenue streams from defense, aerospace, and energy, on the back of orders, I think that they've got from Air India as well as from the Airbus. Margins also should perk up by 30 to 40 basis points going forward from 18.6% to around, say, 20% over the next 12 to 15 months. But all in all, I would advise investors to be very cautious. In fact, on your show itself, when Zomato was listed, if you can go back and see, I had cautioned investors to be careful about the frothy valuations of new age technology companies. And we know what happened as the funding winter started. So a similar exuberance is being displayed by retail investors, also by institutional investors, because of large flows coming in through the SIPs. In case of many small and mid caps, this is the time to be cautious rather than regret later.
No, that's well put. Ajay, good morning. Any thoughts on this Kesoram deal with Ultratech?
I think it's very positive, Prashant, because if I just look at the internals of what the acquisition, I think it's coming at a very reasonable 91 EV per ton, $91 EV per ton. And what they end up getting is a very strong 10.7 million tons per annum of cement grinding capacity, clinker capacity of 6.3 million tons. But what's important is that they're getting a surplus grinding capacity of roughly 2.25 million tons. Now that's important. So if you look at the overall deal, I think if I want to look at the internals, the surplus grinding capacity can be valued at roughly around $30 per ton. So that's why I think this $91 per ton seems to be very reasonable. And from Kesoram's perspective also, it will help them in deleveraging their balance sheet. And from Ultratech's perspective, like the Adani Group, they have rolled out a plan, medium-term plan of aggressive build-up of organic and inorganic growth. This goes a step forward in terms of achieving that medium-term objective. So I am constructive on Ultratech Group with the medium-term perspective.
Ajay, hi, morning. I wanted to ask you about this whole GDP print and how to sort of play that in the market. Obviously, one way could be just by, through a cement company like Ultratech, like you mentioned. But otherwise, it's scorching growth, specifically on the manufacturing side. What kind of stocks would you look at now after the run-up? I mean, even an L&T has had a 50% great rally this year. So now for 2024, which would be the capex stocks that you would still consider?
Good morning, Surabhi. I think the manufacturing print has positively surprised the market, and it's mainly led, as you said, if you just look at the internals, the robust demand in cement and steel, and that's essentially because of the lower input cost that one has seen, and the EBITDA growth for cement companies have been particularly strong. Second, otherwise, the monsoon quarter is when we see a flattening in terms of performance. This time, because of uneven spread of monsoon, the performance has positively surprised the market. Uh, I think I would go with some of the cement names rather than some of the capex names, because the capex names, again, there's a lot of fraud. I think announcement of a certain order to be implemented over a 3 to 5 year perspective. And what we have seen that that itself leads to a market cap increase, which is a certain large percentage of the order that has been announced. And this we've been seeing after stock in defense, railways, capital goods companies. So need to be cautious there. Cement companies, in my opinion, still offer good entry points. A company like Ultratech Cement or Ambuja Cement in the large cap, or JK Lakshmi Cement in the mid cap, I think, in my opinion, offers a good entry point. The other point I would like to submission I would like to make is the private consumption expenditure. I think is showing very concerning trends, and there I think a whole host of rural plays I think we need to be cautious about, because the urban sort of demand has held up better, but the rural demand because of uneven monsoon has faltered. And I think hopefully I think if the Rabi crop is good, I think one should start seeing some sort of a perk up in demand in FMCG companies. Otherwise, one needs to be cautious on the FMCG front. The agri numbers also have come in lower at 1.2% vis-a-vis 3.5% in first quarter. So one needs to be cautious on that front. Government expenditure as well as manufacturing are the only two bright spots in the GDP numbers. Again, a word of caution here. In the second half, as you go, there are 3 points we need to look at. There are weaker FDI inflows. Secondly, if you look at the softness, I think in credit growth due to RBI coming down hard on personal unsecured credit growth. And thirdly, I think normalizing base for the year. So that's what's making me cautious in terms of GDP print for second half. Although the market has been surprised positively, and RBI numbers of 6.5%, in my opinion, should hold good. And market would see people who are below 6% should start perking up the numbers to around 6.5%.